What's going on, guys? It's Jimmy here, and millions of people are still reeling here today as the US has basically had the economy downgraded or faith in the US government downgraded as the credit rating Fitch has downgraded the US economy. And this is potentially going to cost the US maybe billions of dollars more to issue government bonds and to issue debt going forward here. And this is a major big deal. I think this is maybe only the second time this has happened, or maybe the second time in recent history here, that the US government has basically had its own credit downgraded here, and very, very significant. And it's basically because of the lack of faith in Congress, but also because of the significant debt that the US government is taking on and continues to take on and has for many, many years. Take a listen to what Shark Tank star Kevin O'Leary has to say, a famed investor, and the warning he has. Take a listen here.
Second time in our nation's history, the country's credit rating has been downgraded, and that is no good. Fitch ratings point to rising debt and a, quote, deterioration in standards of governance. Treasury now calling the cut arbitrary, but it could actually cost taxpayers. Mr. Wonderful is Kevin O'Leary. He's got a take on this now. Nice to see you, sir. Good morning to you. We were in the same spot 12 years ago. 2011 was the only other time. What do you make of it as the Biden administration pins a little bit of this blame, not a little bit, maybe a lot, on Donald Trump? Go figure.
Well, it's really about government and policy. There's no way to sugarcoat this at all. It's bad. And I'll tell you how you measure it's bad. Basically, when you downgrade the U.S. economy, which is what this downgrading is, you are losing a little faith in the U.S. dollar and the U.S. Treasury bill, because the default currency of the world, defined by every commodity priced by U.S. dollars, is the good faith of the U.S. government. And the whole world trusts it. Most sovereign funds keep the majority of their liquidity in U.S. dollars. That got hurt 24 hours ago, because now you start to ask yourself, well, where is this going? A downgrade from AAA to AA, does it go to single A? Now, if you're a sovereign wealth fund, you start to put that in your mind, and the bottom line for you and me is the cost of capital goes up. In other words, what it costs for us to borrow money to fund the government in deficit goes up. No sugarcoating that. Now, how does this actually affect the next 24 months? Well, let me explain. Think about the CHIPS Act and the Inflation Reduction Act. We're printing billions of dollars. Government claims it has merit. It's important to do this. But at the same time, that's just a lot of spending, and that increases the deficit. And that's why Finch did this. They downgraded it. And I wouldn't say it was the two bills that caused the camel's back to be broken, but it was enough for them to say, okay, I've seen enough. Now, for me and you, or anybody at a kitchen table in America, your car loan just went up from 5 to somewhere between 7 and 9%.
Really?
That's not going to help. So the cost of your loan and your borrowing and your mortgage going up, period.
Okay, so that's on the economic side of it. But on the political aspect of the Biden administration was defending itself, and they pointed repeatedly to January 6th, from a political standpoint that leads to a lack of trust on behalf of those who are investing in the United States of America. Now, do you think that to be true?
I think that's a political statement, Shirley. I mean, really, this downgrade is about debt and the ability to pay it back. It looks beyond any one event. Doesn't matter. The more the government goes into deficit spending, the more rating agencies scrutinize the quality of that debt. And if you thought we got to the point of no return where it was impossible to pay this debt back, you'd rename the United States of America Venezuela.
Wow.
So that's what you got to start thinking about. It's that simple. We're nowhere near that yet. But, investors like me look at this every single day and say, what happened there? What happened in the last 24 hours? And how does that change my propensity to bet on the United States of America as a long-term good gamble where I put capital to work? And that lost a little bit last night on the downgrade.
Okay.
There is, I keep pointing this out to people. How can you possibly spin this in a good light? There isn't one. There's no good news.
Okay, so we got 2023 and we got 2011, 12 years apart. Next topic quickly now on BlackRock and investments in China. This got our attention. We don't know what it means, but this is Larry Fink's defense. It is unconscionable for any U.S. company to profit. This is the House Select Committee's letter to Larry Fink. It is unconscionable for any U.S. company to profit from investments that fuel the military advancement of America's foremost foreign adversary and facilitate human rights abuses. They allege that their investments in Chinese companies are helping these aspects of Chinese society to do bad things, essentially. Do you see a case here or not, Kevin?
Well, I see a case for Larry Fink being fried under a microscope. You know, it's just like burning an ant with a magnifying glass. That's what's happening to him right now on the Hill. And the reason that's happening, maybe they could make an argument about that funding the Chinese army and espionage and all the rest of that, but that's not his problem. His problem is lack of transparency. When I invest in the world's largest money manager in an index fund that's global, a portion of that is based on the larger economies. It's prorated by the size of an economy. China gets a big chunk. What I don't get, and there's no information for me to get, is the transparency specifically of what those investments are. So the only defense Larry Fink has and BlackRock has is to shine the light of transparency on every single investment so that you can see whether or not these allegations are true. Yeah. And you don't get to do that in an index fund. It's very hard to. So that's his only way to do it, whether you're a retail investor, an institutional investor, or actually a sovereign fund that's managed by a government. Well, he has to do that. And the other problem he's got is ESG. He's got ESG issues. People are asking, why do you make these decisions? It's opaque. We don't know. Lots of issues around transparency here.
Okay. Yeah, so you can see Kevin O'Leary, Mr. Wonderful, spouting a lot of the truth there, or at least as a realist would see it. You heard him talk about a lot of loans and interest rates going up. Take a look here. Mortgage rates rise as Fitch downgrades U.S. government. And I went and searched for mortgage rates right now. Google defaults it at between 700 and 719 credit score. Coincidentally, I Googled what is the average credit rating. It comes out to 714 is the average credit score for a FICO score in the United States. I guess it varies based on generation, believe it or not. The average credit score in the U.S. is 714 FICO score, a 702 Vantage score, considered a good credit score. Gen Z, which is 18 through 25-year-olds, has the lowest average credit score at 679, mostly probably because they're not, not that old, aged 18 to 25, and still kind of getting established. While the silent generation, aged 77 plus, has the highest at 760 as the average credit score. Average, again, being the key word there. You can see mortgage rates have now increased to, on average, for a 700 to 719 score. For, again, we'll pick a couple states here. For Ohio, at 7.85% for a 700 to 719 score in Ohio. I'll pick a couple other large states here. California being the largest state population-wise, 7.82%. California has like almost 50 million people, or somewhere around 50 million people. Getting up there really, really high, at least for recent, this century, right? Texas, 8.02%. Yikes. Over 8% with a 700 or 720 credit score. Wow. You can start to see the problems boiling over here with the Fed raising interest rates, now the downgrading of the U.S. credit rating, and all of this starting to boil over. The Fed could even be raising interest rates here yet again this year. I'll keep you up to date on this. Let's check maybe one more here. Another massively large state and population, New York. 7.79, 7.8%. Absolutely just really, really high here. New Jersey, 7.8%. So you can see around 7.8%. That Texas one at 8%. You can see things are getting out of control. And every time they raise interest rates, it raises your credit card interest rate there as well. A lot of people don't even really even know that their credit card interest rates have been creeping up over the months because they can just raise those at will and just it says right in your fine print that they're variable interest rates. They can go up at any given time. It says it right in the fine print. Yeah, and the average credit card interest rate over 20% now. The highest credit card interest rates around 35% now. And this is really starting to take its toll on most Americans, whether it's credit card interest rates, mortgage interest rates, personal loans, car loans. It's hitting almost everybody and businesses, small businesses, medium businesses, even large businesses that have to issue debt. They have to pay interest in one way or another. This is starting to affect everybody, even the US government, which is now somewhere around paying $1 trillion a year in debt. And as they're issuing new debt or old debt is getting refinanced, they're starting to pay more and more and more. So pretty much everybody is affected one way or another. The only people that aren't really affected are the ultra rich. They're just actually making more money off this because they're not paying debt, they're making money off the debt. So if you actually have money in savings accounts or money market accounts, which is kind of like a savings account, money market accounts are actually paying over 5% now. Probably the easiest one to kind of go at is Vanguard Federal Money Market here. It has a $3,000 minimum, but again, this is just one that I know of here. Vanguard Federal Money Market. The ticker symbol is VMFXX. Has a $3,000 minimum, but it pays 5.24%. And basically, you can just get your money out at any given time. You just cash out, and it sends the money to your bank account. The next day, or 2 days later, something like that. But it's basically like a checking account, but with a 5.24% return. Yeah, so this is kind of the advantage for high interest rates is that CDs, money markets, which is kind of like a checking account, if you know what a money market is, are paying high returns. In fact, this is probably better than a CD because, when I'm looking up like CD, certificate of deposit rates, they're paying, 5.25%, 5.3%, 4.5% on 5 years. So like the only reason you would maybe want to do that is if you really wanted to lock that rate in for long term. I definitely wouldn't do that for a year. I would just keep it in the Vanguard money market because you can, Vanguard's a multi-billion dollar company. It's one of the largest investment companies out there. And they're one of the lowest fee companies out there. I'm not sponsored by them or anything. But the only way I would do a CD is if you were like locking in a longer rate, like a 3 to 5 year, and you want to kind of, lock in one of those longer rates and kind of play the odds there, right? Because thinking that rates could go down, but if you just wanted short term, what is that? That's terrible, right? And this is where like the age old saying of the rich get richer, and the poor get poorer. And this is where like if you're trying to manage your money and you're trying to get out of debt, and if you're trying to be on the rich get richer side instead of the poor get poorer side, it's just simple like knowledge. Knowledge is power, right? What the rich do, or the people that are trying to get richer instead of get poorer, it's just simple knowledge, right? Is get out of credit card debt, start paying your balance off every month, and the credit card companies will start paying you. Okay. So instead of paying 20% plus per year in interest, okay, so on a $10,000 balance, you're paying $2,000 a year in interest, 20% every year. So instead of paying the credit card companies 20% every year, So you go to the grocery store, you put $200 of groceries on your credit card, and all of a sudden you're paying $300, $400 for that in interest or in total because you're paying the minimum, and it's just you're paying the minimum, you're paying the minimum, you're paying the minimum, and that adds up and it just compounds negatively for you. What you do is you eventually start paying that off, right? You pay that off, you use the snowball effect of where you pay off the lowest balance credit card. Once that one's paid off, then you make that payment on the next lowest balance credit card, and then you're making double payments off that, and you just keep paying those off. What the rich do, or even the middle class that are working towards being wealthy, is that once they pay off their credit cards or pay them off in a row, they take their credit card and they just set them to auto pay, okay? Or just pay them off every month, right? And they just have enough money to do that. So when they go and they buy their groceries, they buy their $100 or $200 worth of groceries, they put it on their credit card, right? But they pay it off in full when the balance comes, and they get rewards for it. Okay, there's credit cards that have 5% grocery cash back, okay, or American Express with even 6% cash back. I think that's a business card, but regardless, is that they use some rewards program cards. They get their 5% cash back, and then instead of paying 20% interest, shop around for whatever different cards, 5% on gas, 5% on groceries, etc. Okay, then instead of paying 20% interest, they're now getting 5% cash back. That's a huge difference over the course of a year, and then another year, and then another year. So instead of losing money negative 20%, 20%, 20%, now they're gaining money. They're paying it off. When you pay it off in full every month, you get no interest at all. And then they'll start to pay you rewards. So on every $200, they're paying you 5% on 100 is 5, 5% on another 100 is 10. So instead of paying $200, you're now paying 190 because they paid you 5% cash back on groceries. And then you got another card that's 5% cash back on gas. So instead of paying 20% and paying $240 for your groceries, you paid $190 for your groceries. You literally made $50 in difference there on one grocery bill. So think about $50 you saved every single time on groceries because you didn't pay interest of 20% and you saved 5% by using a 5% cash back card on groceries. And now apply that every time you go to get groceries, and then it doesn't compound it negatively for you year after year after year. And that's just one simple change you can make. The rich get richer and the poor get poorer. And it's just simple things like that that they do year after year after year. Yeah, these are just things that average, everyday, regular people can do over the course of time. So let me know your thoughts here in the comments. I'll keep you up to date here. If you haven't yet, subscribe down below. Click the bell icon. It's completely free to do so, which is the best price ever. And thanks for liking and sharing these videos. Click here to see about the nationwide bans that are happening right now, or click here to see about the massive food price spikes that are happening. Click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.